Everyone's trying to predict the next move in the market, but most people are watching the wrong chart. The biggest driver right now isn't earnings. It isn't inflation. It's geopolitics. And if you ignore it, you'll keep getting blindsided by moves that don't make sense until it's too late. Welcome back to Golden Bull, where we cut through the noise with clear frameworks, real risk rules, and a community-first approach. If you want hype, there's plenty of that on YouTube. If you want discipline and real market structure, you're in the right place. Today, we're breaking down what to expect next in the markets and why geopolitics matters more than ever. Quick reminder, this is not financial advice. I'm sharing analysis and probabilities, not predictions. The goal isn't to guess every move. The goal is to position smarter than the average investor and manage risk like pros. Now let's start with something important. The market is not trading fundamentals alone anymore. Traditionally, markets were a fundamentals game. Inflation, interest rates, earnings, employment, economic growth. That stuff still matters, a lot. But over the last few years, the market evolved into something else. Now the market is also a geopolitical machine. And geopolitical news doesn't move like fundamentals. Fundamentals change slowly. You can track trends. You can see it coming. Geopolitics hits the market like a lightning strike. And that's why we're seeing violent moves, fast rotations, sudden risk-off days, and rallies that appear out of nowhere. To most people, it feels random. But it's not random. It's geopolitical pricing. So what does geopolitics actually change? Because a lot of people hear geopolitics and they think it's just headlines. Something to talk about on the news, something that doesn't really affect their portfolio. That's outdated thinking. Geopolitics is a major input into the global financial system now, and it moves the market through three main channels. The first channel is energy and commodity supply shocks. When conflict or tension hits global supply chains, the first reaction is almost always commodities. Oil, gas, shipping routes, industrial metals, food supply, fertilizer. When those inputs get unstable, prices move. And when prices move, inflation expectations move. And when inflation expectations move, central bank expectations move. So a geopolitical event doesn't stay in the news category. It becomes a market event because it changes real-world inputs. The second channel is risk sentiment and capital rotation. When geopolitical risk rises, money doesn't sit around and wait. It moves. It rotates out of high-risk assets and into defensive assets. That usually means you'll see strength in the dollar, strength in gold, strength in defensive sectors, strength in certain commodities, while growth gets hit and smaller stocks get hit. And crypto? Crypto becomes more volatile, because crypto is highly sensitive to risk sentiment and liquidity. And the third channel, the one people ignore the most, is government response. Sanctions, defense spending, industrial policy, trade restrictions, alliances shifting. This is big, because this is the part that changes the rules of the game. Geopolitics isn't just news anymore, it's policy. And policy moves markets. So with all of that in mind, what should we expect next? I'm not here to give you one forecast. The smartest way to operate in this environment is to think in scenarios, because geopolitical markets punish certainty. They punish ego. They punish people who get married to a prediction. So I'm going to give you three scenarios: a base case, a bull case, and a bear case. And more importantly, how to position and think through each. Scenario 1 is what I call controlled volatility. This is the base case. This is where markets stay volatile but generally trend higher in waves. Headlines keep hitting, but they don't escalate into major global disruption. It's a market full of fake-outs, but the bigger structure stays intact. In this scenario, you'll see strong rallies, sharp pullbacks, rotations between sectors, and in crypto you get explosive runs followed by brutal shakeouts. This is a trader's market. It's also a disciplined investor's market. Dip buying can work, but only with risk management and patience. Scenario 2 is the risk-on melt-up. This is the bull case. This happens if tensions cool down or markets become confident that geopolitical risk is manageable. In that environment, money gets more aggressive. It rotates into tech, into growth, into AI themes, into high beta stocks. And crypto absolutely loves this environment. This is where Bitcoin pushes higher, where liquidity flows into alts, and where narratives take over. This is where people start calling for ridiculous targets again. This is where altcoins can go insane. But the key thing to remember is, risk-on markets feel amazing until they don't. Scenario 3 is the escalation scenario. This is the bear case. This is when geopolitics triggers true supply disruption or true financial stress. This is when the market flips fully into risk-off mode. And in risk-off markets, cash becomes king. The dollar strengthens, volatility explodes, and anything dependent on liquidity gets hit. And I want to be very clear about something. Crypto is not a safe haven during escalation. Crypto is a liquidity asset. When liquidity disappears, crypto dumps first and asks questions later. Now that brings us to the most practical part of this video. If you want to trade what comes next, you need to watch the right assets. Most people only watch the S&P and Bitcoin and think that's enough. It's not. In geopolitical markets, the instruments that matter are the global risk gauges. Number 1, oil. Oil is the energy risk gauge. When oil spikes, everything changes. It shifts inflation expectations, it changes central bank forecasts, and it pressures consumers and businesses. Number 2, the dollar. In global stress, money runs to the dollar. A strong dollar often means pressure on emerging markets, pressure on growth stocks, and pressure on crypto. Number 3, gold. Gold tells you fear is rising. It's the market's trust index. When gold is strong, people are buying protection. Number 4, bonds and yields. Bonds tell you what the market expects. Recession, inflation, cuts, crisis. This is where the real story gets told. And number 5, Bitcoin. Bitcoin is the liquidity thermometer. Bitcoin isn't just a chart. It's a live reflection of risk appetite and liquidity conditions. If Bitcoin is strong while fear is rising, that tells you something powerful. If Bitcoin starts breaking down while oil and the dollar spike, that tells you something too. So what should the Golden Bull community do with all of this? Here's the truth. In geopolitical markets, prediction gets punished. Flexibility gets rewarded. So here's the Golden Bull playbook. Number 1, trade scenarios, not opinions. You are not married to a bias. You are prepared for multiple outcomes. Number 2, stop getting shaken out by headlines. The headline is not your signal. Your plan is your signal. Number 3, respect volatility. In high volatility, your position size should shrink. That's how you survive the shakeouts. And number 4, risk management is everything. The goal isn't to win every trade. The goal is to stay in the game long enough to catch the big moves. That's how pros win. And if you've watched this far, you're exactly the type of person this channel is for. So drop a comment with your top market fear right now. And what asset you're watching most? Bitcoin, oil, gold, or the dollar? And if you want the watch list and the key levels the community is tracking, subscribe. This is your Golden Bull. We move as a community, and we move with discipline.